Welcome back to Return My Capital. Today's a big day, big announcement. It's the annual SCHD Reconstitution. This occurs every March where companies are removed from the SCHD ETF in addition to companies that are added. So quickly, I'll cover some methodology of how this is conducted. So basically, SCHD looks for companies that have 10 years of consecutive dividend payments. You have a minimum market cap of $500 million, and there's a $2 million daily average trading volume over the course of 3 months. So basically, the companies need to be liquid. Stocks are then ranked by yield, and the top 50% of those yields are eligible for inclusion into SCHD. And then finally, free cash flow to total debt is considered, that ratio. You also have considerations for return on equity, dividend yield, and the 5-year dividend growth rate. And then just a general rule of the SCHD ETF is a 4% maximum allocation to any single holding. So when this reconstitution is performed, the very first day, no company will be weighted over 4% of the total fund. And then, obviously this can change over the course of the year as certain companies overperform, underperform. That percentage will change, and we'll take a look at that here in a moment. And no stock sector can be over 25% of SCHD when that reconstitution is implemented. So we'll go ahead and share this screen spreadsheet right now. So here I'm showing the old top 15 holdings of SCHD compared to the new top 15 holdings. So let me go ahead and zoom this in a bit more so it's a little bit more visible. So you'll see the old top 15 holdings: AbbVie, Amgen, Coke, Bristol Myers Squibb, Chevron, Verizon, Cisco, Altria, Texas Instruments, PepsiCo, Lockheed Martin, Home Depot, UPS, and EOG Resources. You'll see their yields and payout ratios there. So those are the old top 15 holdings. On the right of that will be the new top 15 holdings. Anything highlighted in a light green there are companies that are going to be moving up in its positioning within the ETF. So ConocoPhillips, Chevron, and Verizon will be your top 3. And then you see a couple of the companies sliding down in their total allocation. So that's a quick look at top 15 old and new. And then just a couple additional notable additions and removals. So you've got Merck, ConocoPhillips, Schlumberger, Target, General Mills, Archer Daniels Midland, and Halliburton coming into the SCHD ETF, and Pfizer, BlackRock, US Bancorp, Dick's Sporting Goods, and Leggett and Platt being removed. So those are some just high-level changes. Quickly kick into the SCHD metrics here. So you'll see over the last 5 years, up nearly 100%. Over the past year, up a mere 6%, 10-year returns, 114%. As I'm sure you're well aware, a beautiful 0.06% expense ratio on this quarterly dividend-paying ETF, currently yielding 3.54%. You see the ETF grades there, grading out very, very favorably: an A+ on expenses, dividends, and liquidity, a B on momentum, and a C+ on risk. Kicking down to the returns, you'll see the, price return over the past year, just over 6%, the 5-year just under 100%, and just over 112% price return on the 10-year. Looking at the total returns of SCHD, so dividends included, you're looking at 192% on the 10-year returns for total, 135.5% on the 5-year, and 9.25% over the 1-year. You can see how that compares to S&P 500 total returns. So say maybe your VU ETF compared to SCHD. You'll see that the S&P 500, on the 1-year total return, it's beating SCHD by about 2.5%, 15% on the 3-year, 19% on the 5-year, and 39% on the 10-year, but that may not be the total story, the whole picture of why you would invest in an ETF like SCHD. Now, these are the current holding breakdowns from a sector perspective. You'll see healthcare, financials, consumer defensive, energy, industrials, and technology rounding out the top sector holdings. And then just quickly looking at some of the, there on the left, you'll see the current top 10 holdings. Again, I already showed, you can go back, pause the video, already showed how the top, 15 will be changing. Dividends, annual payout at 99 cents. You'll see the yield at 3.5% and a 5-year dividend CAGR of 5.5%. Next, let's see. Let's just quickly compare to some of the other very popular dividend ETFs, VYM, DGROW, HDV, and VIG. Across the board, very, very nice low expense ratios on all these ETFs. You can see the AUMs of these ETFs, the yields, and that 5-year growth rate of the dividend. So just wanted to do a quick run through of what you can expect when this reconstitution goes in place. Again, here are your old top 15 holdings and your new top 15 holdings. It's always exciting when this happens every single year. So thank you very much for watching Return My Capital. If you enjoyed the video, please consider subscribing. Thanks again. Take care. Bye-bye.